All right. Welcome to the first study time with Steve of 2024. Today with me, I have Robert Bullock. He is our Chief Wealth Manager here at the firm, and we're going to jump right in. So here for all the lawyers in the audience, please read this carefully, make sure we didn't do anything wrong. And we'll jump right in. So, you know, the one thing that I think I've been hearing most from people recently is that a lot of this rally that we've been having over the last few years has been driven by people just, paying higher prices for stocks. And when you actually look at what has driven returns over the last 4 years, it's actually been earnings. Companies are doing better. Yes, I think a lot of that has to do with inflation and stocks being able to up their prices, or companies being able to up their prices during this time. But when it comes down to it, 90% of the return, 85% of the return is due to growing earnings. Has very little to do with multiple growth, which is people wanting to pay higher prices. Actually dividends have accounted for more of the return of stocks over the last 4 years than multiple growth has. So it's a very interesting situation where I hear that people think that it's more driven by, oh no, people are just, it's a bull market. People are just buying stocks for no reason. It's, stocks go up, machine go burr, kind of a meme mentality, but I don't think that that's the case. Have you been hearing that too, Bob?
Yeah, I remember when the Fed began to raise interest rates in early 2022, corporate America was convinced that we were going to go into a recession. So corporate America really early began to tighten up the ship, let people go to prepare for what they thought was going to be a very difficult 2023. And lo and behold, it wasn't that bad. The economy held up well, and corporate America is in pretty good shape.
Yeah. And then I always, if you've been on the two I did last year, I like to look longer term. And this is what it looks like long term. This is from 1945. This is what it looks like from the S&P 500 reported earnings. That's the blue line. And the green line is the S&P index. So you can see what drives returns over the long term, and it's earnings. Companies have better earnings over time, and that is how you get, your return in your portfolio. Anything to say here, Bob? I mean, this one is my favorite because it points to, if you had to look at one thing, it's earnings, and then that comes back to the consumer. The U.S. economy, 70% or so, 2/3 of the economy driven by the consumer. So as long as people are making more money, as long as people are out there buying things, you could expect the S&P will go up with it.
Steve, it's amazing. Look at all the politics we've gone through. Look at all the world events, the wars that we've gone through. Corporate America, and if you will, capitalists have a really good ability to adapt whatever is thrown at them.
Yeah.
And it's always been my view longer term that capitalists have a really good idea of how to come up with something new, something that will cure something, or something that will solve a problem. And corporate earnings sort of reflect that.
Yeah. Okay, next slide. Bob, this one's yours, so why don't you go ahead and jump in on this one?
Yeah, I love this chart. It's like a chemistry chart in high school, which don't have fond memories of. But it's rather complicated, if you will. If you look all the way to the right, it shows from top to bottom.
It's on the left now. They switched it, Bob.
Yeah.
It's on the left now.
Okay. On the left, if you look at top to bottom, from 2009 to 2023, all the way to the left, annualize which of the investment options that we have was the best performing group at the top, going down the chart as to what was the worst performing group for those 14 years. And obviously, if you were in large cap stocks, you averaged about a 14% return over those last 14 years, followed by small caps, REITs, high yield, a typically diversified portfolio of 60% stocks and 40% bonds. You didn't shoot the lights out, but you also didn't lose your shirt. And that's the reason why we like balanced portfolios. Interestingly, which I'll talk about in a moment, the next, if you will, worst performing groups were international stocks, both developed markets and emerging market stocks, and then some fixed income and some cash. The worst performing over the last 14 years, probably not too surprising looking back, because we were going through moments of deflation, have been commodities. Did well in 2022, but it's been the worst performing group for quite a while.
Yeah, the interesting thing to me on this chart, Bob, is large cap stocks. So that's the S&P 500. Long-term average return is 10%. So over this last 15-year period, we've definitely done much better than that. But if you're saying 10% long-term average, and then an asset allocated portfolio got you 8%, so you got significantly less risk in that portfolio than sticking with just large cap stocks, and you still got 8%. I mean, this is a really great 15-year period.
And it's a much smoother ride with that balanced portfolio.
Yeah, for sure. And coming back to, do you expect large cap stocks to do 14% over the next 15 years? S&P, that's a hard ask, especially when you look at the long term. And if you look at this chart going from before 2009, the 15 years or 10 years before 2009, it's completely flip-flopped. The large cap stocks are basically at the bottom of that chart. So it's a moment in time. It's 15 years, but what will the next 15 years look like?
Yeah, I always like to remind clients, Steve, that pension funds are looking at this thing, and they're looking at an area that's getting more expensive, and they're looking at, obviously, at the bottom of the chart, things that are getting cheaper and cheaper and cheaper.
Let's move on to that, because I think that's the next chart, right?
Yeah, and at some point it sort of switches. I'm going to highlight, if you will, some things that are cheap at the moment. The chart on the left shows price to earning discounts to US stocks. Typically, we're able to buy international stocks cheaper than US stocks. And as it says in the middle of that left chart, typically we're able to buy international stocks at about a 16% discount to US stocks. Where are we today? You can buy international stocks for a third off. Will they get cheaper? I don't know, but historically, I'll buy anything a third cheaper, frankly. And in the chart on the right reminds everybody that international stocks typically pay higher dividends than US stocks. Typically, international stocks pay about 1.2% more than the average stock in the United States. Today, it's just under 2%. And so if you got some international stocks, or if you're buying international stocks, not only are you buying them for historically at a cheaper price, you're also being paid the weight a little bit more. A good opportunity, frankly.
Yeah.
And Steve, the next chart, a little bit complicated on the left, but it says global earning estimates. Why are international stocks so much cheaper? Well, once again on the left chart, the black line is U.S. Earnings estimates, which happen to be going up and are being revised up for 2024. The rest of the world's having some problems, frankly. Japan possibility is going into a recession. Europe has deteriorating earnings, growing less than the United States. And China, the world's second largest economy, obviously is having some difficulty with real estate and consumer spending. You may have seen it on the news, they're going to have a 5% growth target, which is half of what they've been growing over the last decade. And so there's a reason why international stocks are cheap. And it sort of goes back to Steve's original premise. You buy stocks because of earnings. And at the moment, the place to be is the United States.
Yeah, definitely.
But if you look on the right-hand chart, it sort of puts in perspective how cheap things are right now if you're buying anything outside the United States. Once again, on the right chart, historically in the United States, the 25-year average is roughly 16 times earnings, with a large range. Today, you're buying it at 20 times earnings, much above average. So you're buying stocks in the United States historically expensive. The rest of the world, Japan, Europe, emerging markets, and China are all below their 25-year average. And so, once again, it's an attractive entry point for longer term investors. And frankly, if you wanted to play, maybe if the dollar is going to be going down at some point in the future, maybe because we got trillions and trillions in debt, having some exposure outside the United States is a good way to play that falling dollar.
Yeah. Yeah. I mean, again, coming back to the earnings side, back to my original point, that is going to be what drives these returns over time. Do we know when those will change? That's the harder question. I think a big part of this is that tech has eaten the world. Tech exposure in the U.S., I believe, is something like 27 or 30% of the S&P 500. It's a very large chunk, whereas internationally, tech is a very small portion of those stock markets. And so, as tech has become this huge behemoth in the U.S. and has driven earnings, the Apples and Nvidias and things of the world, the companies outside of the U.S. that are not tech focused have trailed. And so, again, coming back to, do we know when that time will shift, when tech will not be the predominant earnings leader of the world? No, but that's why you diversify. You diversify because you don't know when that's going to happen.
And I'll also add, if tech is also what the future is going to be, if we're going to EVs and we're going to all this new technology, that uses commodities. And if we're going to be using a lot of those commodities, that historically would be quite favorable to outside the United States.
Yep,
and so we may be on the beginning stages of the tech, but at some point we're going to have to dig up the world in order to be able to build all these EVs and electrify the world.
Good point. All right, I'm going to leave with a couple charts just talking about how this year might go. So we finally got a new high in the S&P 500 early this year. It took a little over 2 years, 24.4 months. It was January 19th. And you can see from this chart that 12 months out, after a new all-time high, after a year without making a new all-time high, that a year out, we have an average return of a little under 12% and a median return of 13%. And it's higher 92.3% of the time. So, it's a good sign that we've gone so long without a new all-time high. And now the market has a chance to continue its run, so to speak. One more solid January, and then we had a solid February on top of that. But if you have a January with a 2% return or better, again, over the rest of the year, 12% average return, and 84.4% of the time it's higher. So we've got a couple different signs that we're off to a good start. We've been on a really big run since basically October of last year, but that doesn't mean that it has to end. The caveat to that is that we will probably still go through some volatility throughout the year. You should always expect 2 to 3, 5% pullbacks in a year, and probably 10% or more pullback every year. That's just what you should go into every year expecting in stocks. So this is not to say that we will not have volatility. All it is to say that historically, when these things line up, good things tend to happen for the rest of the year. So,
Steve, wouldn't those pullback be buying opportunities?
Exactly. I mean, that's always what it is.
It's when stocks go on sale.
Any pullback, what's the quote? Any pullback that has already happened looks like an opportunity. Any pullback in the future looks like the end of the world. So it's one of those things where you have to have the mindset that if you're looking back historically, every time the market has pulled back has been a good time to buy. I saw a blog post recently by someone I read talking about the worst timer in the history of the world, and he basically went and did the return of someone who bought every time at all-time highs. Like, in 2007 he bought, and back to 2000 he bought, and like January 1st this mythical person started to feel good at all the wrong times, and his return still, as of today, was still very, very good. Because as long as you hold, as long as you don't sell, you still tend to do well in the market, as long as you just hold on to it. So even buying at all-time highs is not the worst thing in the world. It's the selling. The selling is the problem.
And if you want a smoother ride,
yeah,
diversify those stocks with some bonds.
Yeah, for sure. Yeah, and actually, Mike and I have a diversification webinar that we're going to be doing toward the end of this month that will go into that. And I think there's some really, really good charts in there about diversification and how it can help you, especially when you're taking money out of your portfolio. So that one's going to be a really good one. So tune into that one later. All right, and so with that, thanks everybody for coming. We'll open it up now to Q&A. So if anybody has any questions, just unmute yourself, and Bob and I will do the best we can to answer. I know it's early, and I'm sure I'll get to talk here. I'll ask one. I know it's early, and I'm sure we'll talk about it again as time goes on. But what is your overall advice in an election year, Bob?
Election year is noise. And certain events are noise, and it will affect the market for a short period of time. But at the end of the day, it sort of goes back to the original chart that you showed, Steve. A value of a stock is based upon its earnings. And if companies are, because of a decent economic environment, selling more products and making more money, we know that the stocks become more valuable and stocks go up. Mm-hmm. And so presidents come and go. But I still believe capitalism comes up with good ideas and solves people problems, and that usually represents positive earnings. And we've got a long-term chart that shows, obviously, there's a reason why people invest in stocks. It's because it's a way of making some money and participating in that growth.
I saw an amazing chart that I'd never seen before, talking about investing at the beginning of an election year. And it went back all the way to 1936, and it was showing 10-year returns from that that investment, and every single 10-year return was positive, and most of them were you actually doubled your money in that 10-year period. So one of those things where, back to Bob's point, 100%, it is noise. It's hard to avoid that noise, but in the grand scheme of stocks, the president doesn't really matter. The policies might matter, but really, when it comes down to it, companies are really good at creating those earnings.
Yeah. And,
Jim, hold on. Go ahead, Bob.
No, I would agree with you. I mean, you said 10 years and positive. It's sort of like asking clients, okay, don't open up your statements for 10 years. You'd live a lot longer if you did.
Hard to do, but
very difficult.
Yeah. Jim, you got a question?
Yes. Can you hear me?
Yes, I can.
I always have this conflict in my mind. We're talking about inflation. Everything's high. Everything's costly. But out on the street, if you go into Costco, you can't get in the front door.
Yeah.
If you go down the mall, it's busy. You go in the grocery store, people are coming out with carts of food.
Yep.
So there seems to be, when you drill down into this, the word inflation is thrown out there. But how does it? Can you expand on how does what we call inflation affect the consumer who is still buying as if there's no inflation?
Yeah, I mean, I think what we went through was a significant, bout of inflation. We're definitely paying higher prices everywhere at this point. But when it comes down to it, look at the employment numbers. Those two things go side by side. So when you have employment below or unemployment below 4%, everybody's still feeling good because they have a job. Now they might change their beef for chicken, or they might do some swapping to pay less. But in the grand scheme of things, people feel good because they have money in their pocket, they have a job. Most of the time, they're not afraid of losing their job because everyone's still hiring as well. It's a strange kind of dynamic we're in, because it's not like the inflation of the 70s where the Fed had to put us into a recession to tame inflation. In this case, it was really COVID driven, and employers and companies didn't feel the need to lay people off as much as they did in the past when we had bouts of inflation. So it's one of those things where as long as people have jobs, as long as there's still money coming in every 2 weeks, you should continue to see that. I don't see any reason why not. How do you feel, Bob?
Jim, I would add it's not just prices going up, but it's also the ratio of earnings, salaries. I mean, last year we were seeing reports that you could quit your job, walk across the street, and get a 30% raise. And so, and we've seen obviously unions going on strike and getting very good pay increases. And so wages are holding up. And I think that's the principal reason, once again, as to why we're able to get through this inflation period. The inflation rate is coming down, and wages have held up quite well.
Yeah, and I would also say, Jim, the other thing to note is it's different for, I guess, people still in the workforce and different for people who are retired. Dealing with inflation is tougher, but the best inflation hedge over time for someone who's retired is being more in stocks. That's the thrust of it, is that's why, for the most part, when we put people into portfolios, it's 60% stocks, 40% bonds, because you need that inflation protection when you're retired. You need to have some protection against, my cost of living just went up, and I need to be a little bit more risky to weather that storm.
Well, it's interesting that they seem to be in conflict with each other when you really look at it. And I've always thought, when someone says inflation, well, the normal person on the street doesn't feel that inflation as long as the check keeps showing up.
Yeah, right.
And so it's a scare tactic, in my mind, that the reality of it is as long as you're working and the check keeps showing up, you're going to keep buying, even though the price went from $1 to $3.
Yeah.
And people are very consistent in what they do with very little change. And now we're into an election year. Election years, are those usually more of a positive year than a negative year?
Really, from the research, going back, the worst year is always, I guess, the second year, or not always, but the average, the second year of a presidency is typically the worst. The third year of a presidency is typically the best. The first year is the second best, and then the election year tends to be the third best. Now, on average, it's a positive year. So yes, it's still positive. Like I showed with those last couple charts, we have a lot of other factors that might be leading us to a better year than normal for this year. But typically, it would be, I guess, worse than average, but still positive. Is kind of the way that it shakes out in terms of election year cycles.
Well, I've always said, when I get the reports, just don't open the envelope, throw it in the drawer.
That's a good advice. You'll live a lot longer.
They've done studies on that. Vanguard did studies on that about how often people checked their statements and things like that, and the people who performed the best were the people who basically never opened their statements. So
that's right. Why create trouble for yourself?
Stephen, I always like to remind clients that when mutual funds began in the 1920s, how often would you get a statement?
Yeah.
Yeah.
You got it once a year. because they knew you were in it for the longer term.
Yeah. I appreciate the comments. Thank you.
Yeah. Thanks, Jim. Thanks for the question. All right. Thanks, Bob. That was great.
Thanks, Professor Steve.
Yeah, for sure. And we'll see you next time. We're going to do 4 this year. So and the next one, I believe, is going to be coming up in May. So look forward to seeing you all again then. So take care, everybody.